Bond market investors were in for a rude shock as the union budget pegged the budgeted gross market borrowing number for the next fiscal at 14.95 trillion rupees. Net borrowing, meanwhile, will be 11.19 trillion rupees in 2022-23 as against 7.76 trillion rupees in this fiscal. This higher-than-expected government borrowing pushed yields on a 10-year government bond to nearly 6.9 yesterday, rising to their highest level in nearly 2 years. The yields had risen over 2% on Tuesday and 0.5% yesterday. Even though bond dealers pointed out that the budget documents may not have accounted for the switch with the Reserve Bank of India done on the eve of the budget, which should lower the gross and net borrowing for the next fiscal by at least 63,648 crore rupees. Still, the numbers are much higher than the market expectations that ranged from 10 trillion rupees to 13 trillion rupees. Let us go to Joydeep Sen, an independent debt market analyst, to know if there's more to the yield spike than the government's borrowing plan.
So one is the extent of fiscal deficit and the extent of borrowing from the market. So what it means is, the higher the fiscal deficit and higher the extent of government borrowing from the market, it means that much more fresh supply of bonds in the market. So interest rates tend to move up. Now what has happened this time is the extent of deficit and the extent of market borrowing given in the budget is much higher than market expectations. In fact, even significantly higher than the highest of expectations. Just to give you a number, it is 14.95 lakh crore or 14.95 trillion. But the market was looking at something like 12.5 to 13 trillion rupees. So that is the thing. So much of higher supply has unnerved the market. That is one. And the other is there are talks going on about inclusion of India in global bond indices. That would be a positive because as and when that happens, global money will flow into India. Now, even though that is a time-consuming process, what was expected is two things. One is this time in the budget, the FM will at least talk about bond index inclusion, at least give some ray of hope. And secondly, some tax concessions for FPIs, because that is one of the things they have requested. And there is something called Euroclear and listing of Indian GSECs on the Euroclear system. And for that, preferably, there is no tax on FPI investments in GSECs in India. So the market thought that the government will announce that no tax for FPIs for debt investments in India, which has not come by. In fact, in the press conference, they even say that they are not doing it right now. So these two things, too much of excess borrowing from the market and no ray of hope given about bond index inclusion.
Markets were expecting some policy statement on inclusion of India's sovereign bonds in global bond indices. A green flag to the move could have led to an inflow of roughly around $20 to $40 billion per year, according to analyst estimates, and would have provided the much-needed demand support for G securities. What's also worrying investors is that the high borrowing number will also put the RBI's actions in spotlight as it juggles between role of a monetary authority and banker to the government. The bond yields have pushed up sharply already in response to RBI's liquidity withdrawal. And now, as no new avenue for foreign investors were announced in the budget, the yields could zoom further. UBS Securities, for instance, sees the 10-year bond yield at 7.5%, which will be negative for valuations of stock. Those at HSBC, meanwhile, are mildly bearish on Indian government securities amid forecasts of higher yields. In a post-budget report, the brokerage said, "In our view, it will be difficult for the market to absorb such massive supply in the absence of support from the RBI and at a time when banks may not have as much appetite for holding government bonds given normalizing liquidity conditions and the improving economy. Therefore, we raise our forecast for 10-year GSEC yields to 7.5% by Q2 CY22 and 7.8% by the end of Q4 CY 2022. From equities perspective, analysts are divided on the impact of such sharp yield movement on them. According to UBS, the feed-through of fiscal math into bond yields could be negative for equity valuations, which remain expensive despite recent sell-off. But Joydeep Sen believes, since Indian equities never had a pronounced relationship with bonds, the impact may be limited.
The correlation between equity and bond markets, it is not so pronounced in India because there are distinct factors driving the Indian equity and bond markets. This time it so happened the budget is positive, budget is growth oriented, equity markets have reacted positively. But global listing is important in the sense globally, as and when the US, Fed and other central banks all over the world, they increase rates, they reduce their surplus liquidity. So that will impact the global equity market. And if that happens, that will impact the Indian equity market as well.
Against this backdrop, bond yield movements will be a key trigger for markets today. That apart, weekly F&O expiry, December quarter results, services PMI data, and global cues will be the other indicators.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.